welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
How I've been kind of looking at this is I was expecting 50, and I thought the Fed would try and make it a hawkish 50. And you saw that attempt they had the dissent, they moved rates lower, the projection lower, but nowhere near to what the market was pricing at the end of 2025. And Powell's press conference wasn't super dovish. But I think the reality, and everyone just keeps staring, but they did cut 50, and I think that's giving a big impetus to the market.
We hope that's the case, right? We want to root for the soft landing, and we hope that indeed cutting rates, as aggressively as they did, underwrites that soft landing. And indeed, that's our own forecast. But there are real risks around that.
A bit of a profit taking on the news in those areas that have been perceived as rate sensitive. And at the same time, a catch-up move in that mega cap growth cohort that ultimately does benefit from lower interest rates, but has been a relative laggard thus far this quarter.
Well, we've got 1 hour to go until the market closes, and we're taking a look at the major averages that are looking to close at records, at least 2 out of the 3 major averages. Now, I wasn't here yesterday, sadly, Josh, but it's been so interesting to see really the Fed reaction today, like it was sort of a deferred reaction to the Fed cutting by 50 basis points.
Yeah,
right?
for sure, because yesterday I was here.
Yes.
And I will tell you, as we were kind of waiting for the news and it dropped, and I was surprised, I think, along with other people. I did think they were going to go 25. They didn't. They go supersized. Initially, to your point, Julie, the market was kind of trying to figure out what that meant, and you saw the major averages dip in red, dip in green, dip in red again. But today, different story. Boom.
Yeah, most definitely. And not only that, but like the people we talked to ahead of time, most of whom said if they do 50, it will alarm the market unless they can somehow do a dovish, and that seems to be what they achieved. So the Dow is on track for a record close today. It touched an intraday record. It's up about 577, 1.4%. The S&P 500 is at an intraday record, on track for a record close. By the way, the 39th record close of the year, if it makes it there, which it's up 1.8%. It looks like it's going to. The Nasdaq not at a record, but it is up 2.7% today and leading. What's also interesting is the equal weight is also looking, not sure what's going on there, but the equal weight is up 1.2% and also looking to close at a record today. So it's really seeing all of these gains here today. But it's everything. I mean, it's across asset classes. We are seeing other rallies, right? We've got Bitcoin up by nearly 5%. We got oil up by about 1.4%. We got gold that's also trading higher. And, we continue to see these record type of levels for gold as well.
I saw Dr. Ed Yardeni tell his clients this morning, the Fed is stimulating the economy. The hard landing crowd needs to disperse. His words. And I think initially here, kind of reaction you're seeing, soft landing, risk on.
Yeah, maybe the hard landing crowd is indeed dispersing. So we've got those various assets. Tesla is our top trending stock today, so showing this sort of risk on. Tesla's kind of the poster child in some cases for risk on, or an NVIDIA, or wherever you look at large cap tech. Now, so that's what we're seeing in terms of that risk on. There is one exception to the everything rally. And that has to do with what we're seeing in the bond market. And that is with what we're seeing in treasuries here today. So we've got yields higher. That means prices lower. So this is one of the rare areas where we're seeing prices lower. Interesting, yields moving higher. The Fed cuts, but yields move higher, which is not necessarily what common sense would dictate. We're going to talk more about that in just a moment. But because we are seeing yields move higher, we've got this weird also trade where interest rate sensitive stocks are not doing as well. Real estate down a little bit, utilities down a bit, consumer staples. So this rotation more into the cyclicals and away from the defense.
And of course, utilities has really been working as well.
Yes, it's an interesting day, is what I'm trying to say.
For more on the market's record run, let's welcome in now Julian Emanuel, Evercore ISI Senior Managing Director of Equity Derivatives and Quantitative Strategy. Julian, it is good to see you. So let's start with that Fed decision, Julian. Plenty of people were surprised that Jay Powell delivered that supersized cut. Were you surprised, Julian?
No, we had thought 50 all along. And frankly, we were part of the jawboning crowd that was hopefully pointing them in the way. And frankly, when you think about it, what it is recalibrating the dual mandate, right? And if you look at the Fed's projections are inflation going lower and actually hitting the 2% target in 2026 and down to 2.2 in 2025, whereas unemployment nudging higher to 4.4%. And when you think about it within the context of the fact that we've had 525 basis points worth of tightening since March of 2022, I think the Fed wanted to send a message that it is cognizant of the risks, particularly in a volatile election year. And so that's why we started at 50.
And Julian, interesting that it sort of achieved this. We're seeing stocks rally today. So what are the remaining risks here? I mean, I know you're a bull here. You are expecting the S&P 500 to continue to rally through year end. I believe your target around 6,000. So, but what would be the risks to that scenario at this point?
So taking a step back, we have to acknowledge one thing, and this is something that we wrestled with in the beginning of the year, Julie, but the market is expensive. It's trading on 24 times trailing earnings, and that is sustainable given the fact that there's a likelihood that earnings growth in 2025 is going to be as strong, if not stronger, than 2024, and that the other 493 stocks in the S&P 500 are participating. So what kills a bull market? Two things: undue speculation, froth, FOMO, all of these things. Frankly, we haven't seen it yet. It's possible that we could start that cycle with what we've seen yesterday and today out of the Fed, but it's too early to really make that claim. The other thing, of course, is the recession. And again, when you look at the on-the-ground data, today's weekly jobless claims, the most relevant measure, lower than expected. The economy's in good shape.
Julian, let me ask you another question, which is I'm just curious, how close do you think the Fed is monitoring those financial markets' expectations of a cut? I asked Julian because there were some economists I saw heading into the decision, and their argument went like this. They said, we think actually they should do 25, they said, but they were telling their clients, we actually think Jay Powell could very well do 50 because he doesn't want to disappoint the market. He doesn't want to wake up and say, Jay Powell did 25, disappointed the market, and the market plunged. What do you make of that argument?
So one of the incredible things, and I think part of why the market hesitated at first yesterday in response to 50 was just a sense of confusion. Because basically, for the most part, certainly going back to last week, although the odds skewed up a little bit more coming into yesterday afternoon, it was pretty much a coin flip whether they were going to do 25 or 50. And the market needed to process this message that, in fact, no, the Fed doesn't know anything that we know or don't know about economic weakness, and that, yes, we are able to live continuously longer with this sort of data point uncertainty that the Fed has said is part of their decision-making calculus. So you look to November already, 2 days after the election, and whether they do 25 or 50 is a toss-up the same way it was coming into this one. The market can deal with the uncertainty as long as it continues to see the prospects for earnings growth, and you don't see the economy turn down in a meaningful way.
There's one other thing I want to ask you about, Julian, and that's what I was talking about earlier, the action in the bond market, right? You have the Fed cutting rates, and yet yields going up, right? And you wrote about this a little bit today. What do you think is going on there? And then what are the sort of repercussions of that?
We are not surprised by that at all. And in fact, if you look at what we've called the Fed rate cut playbook, it's very typical, and all the more so when you think about the fact that the 10-year yield has fallen 100 basis points since the middle of April. And so here we are, and there is no recession apparent, and there's no signs of stress in the financial system. The economy looks good. And in fact, inflation We've had, an extremely beneficial fall in the price of oil and gasoline, but that's now behind us. And then the other aspect of it is that both candidates' policies are likely going to increase the budget deficit. You put that all together, and a 10-year yield at 3.6 to 3.7 when the Fed is committed to stimulating by cutting rates on the front end is too low in our view, and that's okay.
Julian, I got to switch gears a bit on you. We have another guest coming on later, Julian, and like yourself, smart, provocative guy. And he had an interesting argument I just want to run by you, which was that as an investor, you have the rate cut and you're trying to look at different ripple effects, mortgages, credit card rates. His argument is that it's actually going to also accelerate this movement towards this new era of AI computing because it's going to mean capital is more accessible for those, the Mag 7, the big tech giants. I'm just curious to get your thoughts on that.
Well, I would step back more broadly, and obviously part of the discomfort that the market has in recent months is whether the validity of AI is in fact valid. And from our point of view, we have always felt that it was a potential productivity game changer. And when I think about when you look at that announcement earlier this week of a $30 billion partnership to build AI infrastructure and power plants and so on, it is absolutely a vote of confidence that the productivity and enhancing potential for AI is real and likely to accelerate, particularly into 2025. And so from that perspective, when we think about the cost of capital, companies that understand how to deploy generative AI will, all else equal, have their cost of capital diminish over time.
And more broadly as well, Julian, as we think about returning to sort of easier money policy, I mean, I recall very well the last time we were in very easy money policy. And in general, market participants were pretty happy during that time. We saw a very long bull market. So how are you thinking about it as we go into this new era, right? Because it wasn't just 50 basis points. It's the beginning of a new era, of a new cycle. So how should investors sort of be thinking about that big picture?
Well, the Fed cutting cycle is, tends to be supportive. And looking out 12 months, stocks tend to rally. And from our point of view, we like this idea of barbelling what you would call the higher beta sectors, infotech, Nasdaq-like stocks, and small caps. Small caps in particular love the concept of a soft landing against more defensive sectors, consumer staples and healthcare. I would caution people in sort of getting the mindset of a new era because that's sort of when you run into trouble. But again, from our perch here, the prospects, the setup for further gains, most certainly into year end and likely extending into 2025 are certainly there.
Julian, it's always a pleasure to talk to you. Thanks a lot for joining us.
Thank you.
We're just getting started here on Market Domination. Coming up, mortgage rates are extending declines, moving toward the 6% level. We'll check in on the latest numbers when we come back. Plus, big tech is booming today. Meta and Netflix hitting records. We're going to speak to a strategist later in the hour about the impact the sector is seeing following the Fed's rate cut. All that and more when Market Domination returns.
Mortgage rates extending declines over the last several weeks. Here with the newest data is Yahoo Finance's Claire Boston. Claire, welcome.
Thank you.
All right, walk me through the latest data.
Yeah, so we just got Freddie Mac data a little bit earlier today, and we are showing an average 30-year fixed mortgage rate of 6.09%. So it's been falling for about 3 months now. A lot of people are saying, is this because of the Fed? And the answer is, well, not directly yesterday's cut. Really what we're seeing is the result of expectations of this Fed cut over several months.
And so now, from what we're going to see from here, do you tend to see a relatively steady decline once the Fed begins that cycle, or is it going to be sort of fits and starts?
It's a little bit hard to say. It really depends on what we expect the Fed to do from here. The Fed was signaling they'll probably cut twice more, so we would expect some of those expectations to lead to lower rates from here, but we might be a little bit range bound. So it's not, a big issue where you really need to time the markets if you're looking to refinance or buy a home.
Yep. So you hear that,
Yeah,
Josh
I did.
Lipton?
I'm listening. When Claire speaks, I listen very carefully. As somebody locked in at 6.5, I listen very carefully.
Yeah, you got to wait a little longer, and then you'll be in that refi window maybe.
All right.
Fingers crossed for Josh. All right, thanks, Claire. Appreciate it. Now let's get to some of today's top trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. And first up, we want to check out shares of Target. The retail giant has named PepsiCo's Jim Lee as its new chief financial officer. He'll become a member of Target's leadership team. That will be effective September 22nd. Folks seem to like the news. The share's up 2%, although the market is up broadly today. And he's going to take over from Michael Fidelki, who then will become the chief operating officer for Target. So he's sticking around.
Yeah, I did see analysts at Oppenheimer quoted as saying they like this move, they like this news. They were optimistic his experience at PepsiCo was going to be additive to Target's grocery efforts. Also says that they also went on to say the current rate backdrop. Nice key positives for the retailer as well.
And Target's sort of been trying to turn itself around. Remember, last quarter, same-store sales were up 2% after 4 straight quarters of declines. The stock is up about 10% year to date, but compare that with Walmart, which is up almost 50% year to date. And you can really see perhaps some of the challenges that are ahead for Target and ahead for this new executive and the rest of the team. Sticking with retail here, shares of Skechers are sinking today. The footwear company says it is bracing for greater than expected pressure in the China market in the last half of the year. And you see there the stock declining, sort of bumping along today and then declining very sharply. That's because executives were speaking at the Wells Fargo Consumer Conference today. That's when those comments hit. And you saw the stock sliding. We're seeing some effect in other footwear companies as well.
Yeah, you should look at the chart. I mean, the past 12 months, still a nice run, but now with this wipeout here, you're in the red year today, Julie, down about 4%. I mean, it's a common theme, right? I mean, plenty of folks expected a post-pandemic boom in China. They didn't get it, and you see all kinds of companies, a lot of different sectors having to navigate that.
Yeah, and apparently the executives are also talking about doing a reset for the quarters that are coming here for what that's worth. I was trying to look at the numbers here. It looks like the company gets around a quarter of its sales from the Asia-Pacific region broadly, unclear what China is specifically, but it's obviously a significant enough portion of their sales that it would affect the stock like this.
For sure. All right, finally here, moving on to Mobileye. Those shares surging after Intel says it is not currently preparing to sell its majority stake, and that is the news. Intel says not currently preparing, Julie, to sell that stake.
Right.
It does hold about 90% of Mobileye, which of course makes autonomous driving tech. Doesn't have any plans to invest that majority interest in the company, saying we believe in the future of autonomous driving technology and in Mobileye's unique role as a leader in development of advanced driver assistance systems.
Yeah, as we know, Intel is trying to, and Pat Gelsinger, the CEO, is trying to right the ship. So he's been doing all kinds of different things. There had been some reports that Mobileye was one of the assets that they were weighing whether to sell in order to raise some additional cash. The problem is, if they sold it, they would likely have to sell it at a loss because Intel bought Mobileye in 2017 for about $15 billion, and the stock going into today was worth about $11 billion. So, we'll see exactly what is going on there. They had the IPO back in 2022.
Yeah, Mobileye, like Intel, I mean, it's been rough sledding. I mean, last month they cut the forecast, the stock hit new lows. Not currently preparing.
Not currently. Doesn't mean they won't ever. All right, with the Fed lowering rates yesterday, we're starting to see a ripple effect in the tech trade with more tech spending and larger venture capital investments potentially on the horizon. For more, we're bringing in Corey Johnson, Chief Market Strategist at the Futurum Group and host of the podcast, The Drill Down. Thanks so much for being here, Corey.
Glad to be here.
Fun to have you.
Got my
in
Yahoo
studio.
purple.
I see. You're always thematic, which I appreciate.
Well, who else do you know who owns many purple jackets? I don't think
Dan
they know.
Ives, maybe?
Maybe Dan
But
Ives.
his are more of a pastel.
Yeah.
A pastel palette. In any case, let's talk about the Fed rate cut and the effect on tech, because we're seeing it, we're seeing it in the session today where tech stocks are doing well.
Well, everything was ripping today, but
Yeah,
yes.
I mean, certainly we had a reset downward for tech stocks at one point when the Fed was not pivoting as quickly as the market would have liked.
Right.
It's become sort of decoupled to some extent, but now maybe we're coupled again.
I think directionally, the 50 basis points, 25 basis points, whatever.
Yeah.
But the direction is everything. Right, and the direction is going to ease up spending. It's going to ease up borrowing, and it's going to there's going to be more M&A. I think, but we're certainly going to see a lot more spending on tech. Where the places where growth is happening is tech, and I think that's why this AI theme is something I think is going to last a generation, and it's just starting right now. And I think you see investors trying to position themselves to capture some of that, especially when money is easier to come by.
Well, and that was one of the points you were making, Corey, which is you were looking at, the rate cut, these kind of ripple effects, kind of mortgages and credit card rates. But one point you were making was you thought this could also accelerate this kind of move towards AI computing because it makes the capital more accessible.
100%. It also makes returns look better, right? The comparison of a return, if we're going to end up with, are we going to end up another 100 basis points below where we are right now in a year? Probably. So that suddenly means returns in equities, growth it becomes more valued, if you will, by the markets, and growth is found in these tech names, and tech names beyond the Mag 7.
Well, I want to ask about timing about this a little bit first, because there are still a lot of folks who argue even with this cut, things are still restrictive. Money is still somewhat financial.
I think that's right.
So I guess the question is, how much further do we go to have to see really the floodgates open in a more decided fashion?
So you just had the great chart about mortgage rates.
Yeah.
Breaking Josh's heart, or maybe giving Josh hope, right? But we saw the mortgage rates started turning down, not when the first rate cut came yesterday, but back in November is when we got to a high. They've been coming down ever since with some bumps along the way. And I think that you're going to see the same thing as it relates to tech spending, that there is a confidence that companies have to invest money in tech and in AI in particular. They've always been spending money on tech, but spending money on AI, figuring out what data they've got, figuring out where there's value. And companies of all kinds are doing that work right now.
Another area, Corey, I want your take on. You live in the Bay Area.
I do.
Right there.
As did you.
As did I, many years, native, actually.
They haven't been the same since.
How does the rate cut affect venture capital moving to the tech sector?
So once again, it's about relative returns, and so there's a lot of investing. It's really interesting what's happening right now in venture capital. I mean, I've been out there for a long time, having come from this very neighborhood. There's a Wegmans in this building.
Oh,
Sure
we know.
is. Yeah.
That's amazing. I come from the land of Wegman, but anyway, the changes in this neighborhood, the changes in the Bay Area are so interesting right now because there are a lot of startups. There are a lot of semiconductor startups getting funding. There have been over a dozen new semiconductor projects announced in the last 2 months.
Is it even about, can I ask you, when they get funding, is it even about, do they even need a product? Or is it like, no, seriously, is it just like, give me the right engineer from the right company?
It's more than a PowerPoint dog and a PC, but there are, because of so expensive to manufacture semiconductors, you end up with investments long before there is a product. But the right teams are getting the right investments, and it's really interesting to see. And it's a place that I've been, like I said, I've been there for a while. I've been covering technology for a very long time. I've been investing in technology for a very long time. But I think this is the biggest boom in new semiconductor companies that we've seen in 40 years.
So you mentioned earlier, beyond the Mag 7, you're also seeing some opportunities. This is something you've been talking about for a while. Is that in semis beyond NVIDIA, or is it elsewhere? Where are you kind of focusing?
I think it's elsewhere. I think it's really interesting in software. I have a personal holding in Oracle, which I won't tell you about my lousy ones. I'll tell you about my great one. But Oracle's been great. But Oracle has Two things about Oracle. So they've seen a big pickup in their business because of their ability to manage data for AI and exploit that. They've also been able to rewrite a lot of their code. There's a really interesting comment in a conference call about, I think it was about 3 quarters ago. They made this massive acquisition of Cerner, the healthcare software company. And they've been going through and rewriting all of Cerner's ancient code. But they've been using AI to do it. And they're doing it 10 times faster than they were before because they've got these AI tools or the same people doing more faster.
Right.
And I think you're going to see a lot of excitement around. We're going to see AI go up the stack, right? So right now there's a lot of focus on hardware, on chips, on disk drives. There's some really exciting things happening just in the software level in the infrastructure side. There's a company, a New York company actually called Vast Data. Private company, probably haven't heard about it. It's a $9 billion valuation in their last fundraising round.
What is it called?
Vast Data, fascinating company, and they've got sort of a system level software that, if you want to think of it, sort of manages the data that's sitting, the AI that NVIDIA chips are creating and managing. But the software level of Vast Data is incredible. It's an incredible business. It's cash flow positive, they have said publicly. I had dinner with the CEO last week, and the business is just exploding. And it's, like I said, it's a company you haven't even heard of. But that's another place where venture capital money has been going, and looks like it's doing quite well.
All right, Corey Johnson, always good to see you in person.
Back in my
Appreciate
hood.
it. Coming up was the Fed decision by the Fed to cut rates by 50 basis points, the right call. We're going to speak to a former Federal Reserve Bank president about the move. On the other side, stick around. Market domination still to come.
Welcome back to Market Domination, sponsored by Tasty Trade. The Federal Reserve kickstarting its new rate cycle with a bold move, lowering interest rates by 50 basis points. Fed Chair Jerome Powell insisting the central bank is not behind the curve, despite a big rate cut. Powell indicating the rate decision should be taken as a sign of the central bank's commitment not to get behind the curve. Here to weigh in, former Federal Reserve Bank of Boston President Eric Rosengren. Eric, thank you so much for being here. Do you think that the Fed was somewhat behind the curve? And do you think that that half-point cut was indeed the right call to kick off this rate cut cycle?
Yeah, so the chair at the press conference highlighted that there was information that they got after the July meeting that probably made them think that maybe it would have been better to do the first cut in July. And that is the payroll employment has been coming in a little bit weaker. With particularly the revisions. So the last payroll employment number was 142,000, but the previous 2 months had gotten significantly revised. And I think what that made clear to many people on the committee was that they needed to start pivoting from being primarily concerned about inflation and being a little bit more concerned that they didn't allow the labor market to slow down too much. And I think the 50 basis points was in effect saying they were going to recalibrate monetary policy to reflect the current economic conditions. So inflation, the PCE, which is the personal consumption expenditure measure of inflation that the Fed focuses on, is at 2.5%. That's quite a bit down from where it was a year ago. And it is much lower than what the committee had expected earlier in the year. So they've gotten favorable news on inflation. The unemployment rate has risen up to 4.2%. And what they're saying is that they don't really want the labor market to weaken any more than it has, that they're getting the kind of progress they were hoping for with inflation. And so that gives them the flexibility to start recalibrating rates. They don't need monetary policy to be nearly as tight as it was.
I'm curious, Eric, we did get the dots, but those aren't set in stone. What does the path of cuts, do you think, look like from here?
So the summary of economic projections, as you highlight, they forecast a number of variables, including the Fed funds rate. The median Fed funds rate was to end this year at 4.4%. That would be equivalent of getting 2 more 25 basis point cuts, and then another 100 basis points over the course of next year, which would get the Fed funds rate down to 3.4%. In my own view, that's roughly what I think the endpoint is. The committee itself thinks that it's going to continue to lower another 50 basis points in 2026 to get down to 2.9%. But there's a lot of question about what the long-run Fed funds rate would be that would be consistent with getting a constant unemployment rate and a constant inflation rate. The committee is currently at 2.9. That's come up from around 2.5 a year ago. And I think they're probably going to end up somewhere between 3 and 3.5%. So I would say the 3.4% might be the terminal interest rate. But that just highlights there's significant amount of easing left. If I'm right, and the terminal rate would be around 3.4%, that implies another 150 basis points over the next year and a quarter.
As someone who has sat in that room and been a part of these discussions, I'm going to ask a version of what Josh asked one of our guests earlier, which is how much sort of market conditions, but more than market conditions, sort of market chatter, what the market quote unquote wants. How much does that enter that room? How much was that a factor, do you think, in this bigger cut? They were sort of on the fence ahead of time. How much do you think that was a factor?
I think the real economic data gets much more weight than temporary financial movements. So I think they were moved more by the fact that they've got very positive inflation information over the last 2 reports and somewhat weaker labor markets. The Fed is trying to influence financing conditions. It affects the short rate, but longer rates are affected by what the Fed does, but what other things are occurring in the economy. So the Fed certainly takes into account financial factors and what the market's thinking, but normally the Fed doesn't react particularly strongly to where the market is pushing. And we've seen over the last 2 years, there have been periods where the market thought that there would be very substantial cuts, and they ended up being disappointed. This time, they were a little surprised that it was 50 basis points. I would say it's a little bit unusual to start with 50 basis points, but I think it probably is appropriate given that ideally they probably would have done the first cut in July.
Eric, great to have you on the show today. Thank you so much for your time.
Good talking with you.
With a presidential election now in the home stretch, GLP-1s still the hottest drugs on the market, and a growing trickle of IPOs too. We're looking at how to navigate biotech stocks with the Yahoo Finance Playbook. And joining us now is Evan Siegerman, BMO Capital Markets Managing Director, Biopharma Equity Research. Great to see you, Evan, on set.
Great to be here on set. Always fun to come downtown.
So, Evan, on the show already, we've talked about the Fed, we've talked about AI. It means there's only one big trend left. And it's in your wheelhouse. You're the guy for it, GLP-1s. You know what's amazing? I went to a family dinner recently, and there was a cousin of mine who had been taking the GLP-1. Literally, I almost walked past him.
That's amazing.
I mean, it was amazing. Now, he is mixing that in. He's hitting the gym. He's got a trainer. But it was remarkable. I'm just curious, that trend. I mean, is it as hot, Evan, as it was, we had you on 6 months ago, 12 months ago? Would you say hot as ever?
It's hot as ever. And we just got out of the European diabetes meeting last week. And there was even more data showing how important these drugs are, really putting Lilly and Novo at the forefront. We had data from Novo's oral amycretin, some Roche data that disappointed, which only points to the market leaders of Lilly and Novo and how they're going to maintain their dominance through the end of the decade.
And yet, the two stocks that you came here with today as your recommendations are not GLP-1 companies.
Hey, listen, I always have Lilly and Novo. I want to talk Regeneron and Vertex, and for what it's worth, Regeneron does have some work in obesity.
Okay.
So that is still there, but Vertex, a great biotech stock, that's not solely tied to the GLP-1 trade.
But I guess what I'm asking is, are you still bullish on the GLP-1 trade? It's just you should look beyond that. Is that what you would tell investors?
I think that Lilly and Novo are likely to remain, outperformers, this year and next year. But I think when looking at the whole portfolio, there's other great stuff happening in biotech, which is why I like Vertex.
Gotcha.
And how make the case for Vertex?
Let's make the case for Vertex. So Vertex, the leader in cystic fibrosis, a rare genetic lung condition. They sell about $10 billion of their core franchise. They're going to have an approval early next year that gets them basically the next generation approved. Could help them pick up patients that they had lost for therapy, helps them reduce their royalty rate owed to another company called Royalty Pharma. Beyond that, the big one, early next year, they should have approval of their non-opioid pain medication. I think this is huge. This would be used after someone has a mild to moderate surgery. So instead of a Vicodin being prescribed, they're going to be prescribed this. And given the opioid crisis, I think that there's going to be rapid uptake. I could see $2 to $3 billion in this setting. And if they get the chronic setting, remember, Lyrica sold $5 billion at peak. So that's $8 billion potential, on the horizon for Vertex.
And what is the advantage of this over, are there any addictive
It doesn't act in the brain, it acts in the periphery, so it's non-addictive, and it works very well. I think that's what's key, getting opioids off the street.
One of the other things that's interesting that Vertex has been doing has been partnering with CRISPR on a couple of things. I believe one of the projects it's sort of backed away from, but still involved with others. CRISPR, the gene editing company. So what are how far away is that stuff?
So the drug that I think you're referring to is called Casgevy. It's been approved.
Right.
And this is a cell therapy to treat and essentially cure sickle cell disease and beta thalassemia. That's present elsewhere in the world. But this is a real cure for some of these patients.
But uptake hasn't been huge, has it?
It's super slow. These patients, their blood cells need to be harvested. Then they have to find a time where they can be in the hospital for at least a month to go under immunodepletive therapy, kind of knock out their immune system, and then re-engraft them with their edited cells. So it takes 6 months. So it's quite a hurdle, but it really works, and it's really transformational for these patients.
You've made the case very well, Evan. I'm ready to pile in.
Sounds
Before
good.
I do,
Okay.
what are some risks I should think about with Vertex?
Some risks you should think about. I mean, the stock's trade in the high 400s. It's already had a great run this year. Not quite Lilly or Novo-like,
About
but
20%, right?
20% is not bad, right? I think the risks are that this launch that I described in pain isn't as strong. That a competitor comes to the market in cystic fibrosis. We really don't see anything meaningful near term, but that could always happen. Or that one of their other pipeline assets doesn't work, right? That shifts sentiment. We saw that in 2020 when they had a blow up in October of 2020.
Evan, we'll have to have you back soon to dig into Regeneron.
I would love to do that. No worries. We'll talk soon. Thank you, guys.
Thank you. Appreciate it. Well, coming up, President Joe Biden calling the Fed's move on Wednesday an important day for the country. We'll hear from the White House Council of Economic Advisors Chair Jared Bernstein on the other side about the progress of the U.S. economy. Stay tuned. More market domination still to come. Mercedes-Benz cutting its financial forecast for the year. The luxury car maker citing a rapid deterioration of its business in China. Remember, earlier today, we heard from Skechers, the shoemaker.
Skechers, Mercedes.
Saying something similar.
Who's next?
So Mercedes now says that, and this is a particular measure of its sales here, its adjusted return on sales will be 7.5% to 8.5% this year. It had been as much as 11% before.
Yeah, here's a message for China bulls out there from the company. This was triggered, the company saying, by further deterioration of the macroeconomic environment, mainly in China. GDP growth, the company says in China, lost further momentum amid weaker consumption, as well as the continued downturn in the real estate sector. This affected the overall sales volume in China, including sales in the top-end segment.
Yeah, and we were looking at the Mercedes shares in U.S. trading, which reacted to this. Obviously, they're closed in German trading. In German trading this year, they are already down more than 5.5%. So we'll be looking to see how they react tomorrow as well. There was a little bit of a knock-on effect on the other automakers trading today, so we'll keep an eye on that as well. Well, President Biden highlighting bright spots in the progress of the U.S. economy at the Economic Club in Washington, D.C. Biden celebrating a new milestone after the Fed made its first rate cut in 4 years.
The Fed lowering interest rates isn't a declaration of victory. It's a declaration of progress. It's a signal we've entered a new phase of our economy and our recovery.
Biden also clarifying that while inflation has come down, there's more work to be done. Joining us now, White House Council of Economic Advisors Chair Jared Bernstein. Jared, it's great to see you.
You as well.
So let's, I guess, get to the more work to be done part, right? Which is that the idea that the Fed is being sort of proactive here in part to forestall any further sharp deterioration in the labor market. How are you in the White House thinking about that part of the equation?
Well, the job market remains, I believe the word Powell used yesterday was solid. We have an unemployment rate that's historically still quite low, 4.2%. And the pace of job gains, while it's definitely slowed, is still at a rate that's associated with maybe the lower end of what we think of as the break-even rate, meaning the number of jobs you need to keep the unemployment rate pretty stable. What we're seeing in the broader economy, because remember, the labor market is a function of consumer spending, investors, and we see healthy developments in those critically important sectors. GDP growth, of course, is coming above trend. Consumer spending remains strong. Real wages and incomes are growing, and that's a real wind in the sails of the American consumer, as well as some breathing room for households. So we see this transition to a more steady, stable growth path as ongoing, and what the Fed did yesterday seems complementary to that from our perspective.
So, Jared, the way you characterize the economy, it seems, relatively optimistic, right? And I'm just curious why, if that's true, why you think your administration gets so little credit for it, Jared. I'm looking at Biden's approval rating on the economy per Real Clear Politics average, Jared. He's underwater. It's just 38%. Why is that? Square that circle for me.
Well, there's a lot going on in that number. It's not just how people feel the economy. I mean, scholars have dug into that. It reflects partisanship. It reflects increasing negative bias in the news. It also reflects an interesting dynamic that I think has had a lot of people scratching their heads. A majority of people say that their financial condition is pretty good. Even that of their town or their state is pretty good, but that of the overall economy is less good. And I think that speaks to some of the general nervousness about where things are headed politically if we end up with a situation where the rule of law is compromised or where federal independence is compromised, a lot of things that would make markets and geopolitics pretty nervous. I think on the overall economy, people are still dealing with prices that are still too high. And that's why seeing lower inflation, lower interest rates, very big story as of yesterday, and the cost-cutting measures that we're engaged in here to lower the cost of housing, of childcare, of healthcare, prescription drugs, junk fees, all of that seems, again, to should close that gap between indicators and vibes.
But Jared, isn't there actually some data we can point to that would explain that sentiment? Wasn't real income growth under Trump stronger than it was under Biden?
No, I think if you look at the gains in real wages, if you look at the gains in disposable income, you'll see comparable growth rates. And certainly, if you look from when the president got here and things started improving relative to when Trump left. I was just looking at a number. Actually, the president cited this number in his speech today. Over his watch, manufacturing jobs were up 740,000. Under Trump's watch, manufacturing jobs were down 170,000. And of course, when he left, the unemployment rate was much higher than it is today. So I think that if you look at, I think the key point here is that under this administration, and certainly the Fed has played a role, we've seen not just lower inflation, not just disinflation, but we've seen disinflation in the context of a much stronger economy than almost anyone expected. I mean, there were major news outlets guaranteeing us 100% probability of recession in 2023. Obviously, we didn't see that, and you heard Powell report yesterday on a pretty positive outlook.
We've been talking a little bit, Jared, about perception, too, which is obviously an important part of the equation when it comes to the economy, because what people spend depends in part on how they feel. And we know that the perception of President Biden's handling of the economy has not been fantastic. There is some new polling data out, though, that shows that Vice President Harris is getting better marks, that her polling is more closely approaching that of former President Trump when it comes specifically to perception of handling of the economy. Do you think, and I know you can only say so much about when it comes to the election, but do you think it's a matter of people wanting to turn the page, whatever that might entail, you know, put that inflation behind them? I mean, how are you thinking about that?
I mean, I'll give you a bit of a response to that, but I want to jump in on something you said that I don't really agree with. You said something about how people's feelings dictate how they spend, and I know that that's a convention. I'm not saying that you're, clearly wrong about that. It's a very conventional, connection, and it's one that we've all grown up believing. It doesn't seem to be the case right now, right? I mean, we have the vibe situation that we just talked about, and very strong consumer spending. I mean, one of the things that you'd actually kind of have to think about right now is looking not at just what people say, but at what they do, because it's pretty different. We have strong consumer spending. We have TSA reporting some of the highest travel numbers they're counting in their history. If you just in your own life go out to a restaurant, they tend to be very crowded. I'll give you a little anecdote from my own life that I suspect is pretty common these days. We went out the other night with some friends to a restaurant. We had a great time. We ate and drank freely. And, then we get the bill and we look at it and we're like, that's up there. And yet we went out and would do it again. And I think that's actually a pretty common dynamic right now. People are out there, they're spending, but they're still concerned about price levels. And I think that's across the board. I think the missing piece of the analysis sometime is that one reason that can occur, one reason that's ongoing, is because incomes and wages are rising. Okay, we just talked about different wage trajectories over different administrations. For the past year and a half, middle and low wage workers, their wage gains have beaten inflation for 18 months in a row. Okay, so yeah, you see you have a graph there showing 3.8% wage growth year over year. Inflation was 2.5% that month. That means real gains were 1.3%, and that's there's the inflation. So anyway, 1.3% real gains. That's 3.8 wage gains minus 2.5 inflation. That's a solid real gain.
Jared, good to see you. Thank you for joining us. Appreciate it.
My pleasure.
For more, we're bringing in now Yahoo Finance senior columnist Rick Newman. Rick, you were patiently and attentively listening to Jared Bernstein. What did you make of it?
I was trying to figure out what that was in the background. It looked like a microwave. I mean, he's in his West Wing office. I mean, is that like a little? And it looked like an old microwave.
Maybe that's how he's saving money so he can go out to
he's got his leftovers from that expensive.
You know what? I have to say. When he was talking about going out to dinner, that you complain about the prices, but you go out to dinner anyway. I had an exchange with my husband today where we were talking about buying concert tickets for something in particular, and I was saying, "Wow, that's more expensive than I expected." And he said, "You'll remember the concert, you won't remember the money that you spent."
You're right. So I take issue with one thing Jared said, and I've done research on this recently. Their real income under Biden has been depressed, and so he used caveats such as within the last 18 months, things like that. Look at that last month where we saw real income gains by 1.3 percentage points more than inflation. I've been tracking this for the Trump economy and for the Biden economy. Real wages, so incomes adjusted for inflation, are up less than 1% under the Biden administration. I'm not saying that's Biden's fault, but that has been the effect of inflation. And when inflation was at 8 and 9% for many, many months in a row, that just ravaged people's budgets. So people are making it up now. They're regaining lost ground, but they are sour about the economy because they are barely keeping up over the course of Biden's term. Under Trump, and I'm no Trump fan, everybody watching Yahoo Finance know that, under Trump, real incomes were up 6.5%. Again, adjusted for inflation. There was a distortion there because of COVID. If you go back to pre-COVID, real incomes were up 4%. That is the reason people think fondly on the Trump economy, because whether you like Trump or not, you felt like you were getting ahead.
It's not how much they were making.
It's both.
Inflation is mostly the swing
it's
there, right?
inflation eating away your paycheck. If inflation is corrosive, and it's ruinous on consumer psyche. It just is. I mean, we look at the numbers. Oh, they're coming down. This hammered people, and they still feel it.
By the same token, he is right that people still spend.
He is, yes. But that's aggregate data. Wealthy people are doing a lot of that spending, and our middle and lower income people going out to restaurants and saying, "Oh, that bill came to $500, but I'm going to go back." I'm not so sure. They're even a little uncomfortable out going to McDonald's.
They're not going to the 500 in the first place.
No.
Yeah.
Rick Newman, always great to see you.
Thanks, guys.
The Dow and S&P 500 on track to close at new highs. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended the day here, and it looks like records for the Dow and the S&P 500. Here's the S&P 500, 39th record close of the year. It touched an intraday record during the session and now has closed at a record, up 1.7% on the session. The Nasdaq Composite, not at a record, but the winner on the day in percentage terms, up 2.5%, and the Dow Jones Industrial Average up 522 points, 1.25%, closing at a record after hitting an intraday record. It's interesting if you broaden it out beyond the three major averages, however, because the S&P Equal Weight Index also at a record here, up less than the S&P 500, but enough to push it to that level. We've talked a lot about the broadening that we have seen. Even though big tech did help lead today, it wasn't just participation there. That's also evidenced by the Russell 2000. We have heard so many investors talk about how when the Fed began to cut interest rates, and even before, that small caps were one of their vehicles of choice. Now the Fed is cut, and you see these small caps outperforming the S&P 500, although again still trailing the Nasdaq Composite on the day. So really seeing this broad rally across stocks and across asset classes for that matter. Jared's got a closer look at today's action. Hey, Jared.
Hey there, a great analysis. Let me just go back to the S&P 500. I'm going to put a 2-month chart with some candlesticks here, and I want to point out yesterday's price action because that was looking very ominous. I'm actually covering up today's, but I just want to point out we had ventured into record territory before the meeting and then closed before the prior day's low. That is a bearish pattern, but today we are closing quite above all of that mess right there. And so that negates it all. That was very important. We still have some warnings, some omens on the horizon, but I'm going to talk about that with Josh in about 30 minutes. Now, the sectors came in pretty strong. Tech, XLK is up almost 3%, followed by consumer discretionary, industrials. Those were the 3 outperformers. And then we had 3 underperformers, 3 in the red, real estate, staples, and utilities. Utilities down the most, about 0.6%. Those were the 3 defensive sectors. So overall, a really bullish day, as you would expect. Also, here are our leaders. Bitcoin had a really nice day, 5% follow through from yesterday. Chinese stocks on the move. Going to talk about that with you, Josh, in a second. And also chip stocks really flying high here. Only solar ending in the red. And just want to close with a seasonality point here. September, the final 2 weeks of September. This goes January to December, 2 bars for each month. The first 10 days of the first 10 trading days. Last 10 trading days of the month, and here we are in September. That big blue cyan bar to the downside is what usually happens in the S&P 500. So that is a tailwind. Despite all the strength that we've seen in the markets, we do have some of those warnings. Guys.
Jared, thank you. Joining us now is Jim Caron, Morgan Stanley Investment Management co-CIO of Global Balanced Funds. Jim, it is good to see you. So Jay Powell delivers that supersized cut. Jim, you call it a catch-up cut. Explain that, Jim.
Yeah, hey, thank you, and good afternoon. Look, I think that Powell wanted to go 25 basis points in July. And I think the committee voted him down, and he looked back with some regret. And I think if you look at the way that the committee voted this time around, it feels like the committee, the FOMC committee, was strong-armed by Powell into saying, look, we didn't go in July 25 basis points. We should have cut. Now we've got to make that up, and we should have already been cutting. So therefore, we have to do the 25 in September that we were going to do anyways. So that totals 50 basis points. What I think is very important to understand is that most people at the FOMC that voted on this for 2024 agree that interest rates should be coming down. But then when you start to look out to where policy rates should be in 2025 and in 2026, what you see is that there's a large dispersion across the voting members at the FOMC as to what their policy forecast actually should be. So this has the earmarks of really the chair exerting his influence and strong-arming the committee in some ways into going to a 50 basis point cut.
What I'm just curious, Jim, because that's a very interesting theory. What brings you to that theory? Is it the dissent by Michelle Bowman, the first one that we've seen in some 20 years? What leads you to that conclusion?
Yeah, so what leads me to that conclusion effectively is the dispersion of views going out into the 2025 year and into 2026. I'm considering the dot plot at the moment. So for 2024, there's no question Fed policy at 5.5% was restrictive. And it's very likely that it needs 100 basis points needs to come off that right away. So for 2024, which is exactly what the Fed's forecast is that they want to bring the policy rate by end of 2024 down towards about 4.4%. So 100 basis points right off the top, I think should start to come out. But then when you start to think about this going out into 25 and into 26, the opinions start to vary quite a bit. So it doesn't seem like there's this unanimous view that the Fed needs to go so aggressively, but they do believe that rates are too high, probably by at least 100 basis points. And then after that, we should go slowly. Because remember, what the Fed is now forecasting is that they're going to cut rates 25 basis points per quarter in 2025. And they're going to go 100 basis points between yesterday and the end of the year.
You know, you were surprised, Jim, they went 50, so was I. A lot of people were. They were expecting 25. What are the risks of doing a half-point cut?
So the risks are two-sided, right? So the first risk that I'll say is that is that if they go too aggressively too quickly, they could potentially reignite some of the inflation fears, inflation concerns. And if inflation becomes unanchored, that will prevent them from cutting rates as much as they'd like to cut in the future. But on the other side of this is if they didn't cut rates aggressively, then it could be that the unemployment rate starts to accelerate higher, and then they have a much deeper downturn in the future, and then they have to be more aggressive in terms of their rate cuts later. So the risks are twofold, right? So this put them in a really difficult position. Do you go quickly now and have the risk of inflation, or do you go too slowly at this point and have the risk of a deeper downturn? And they elected to say, look, we would rather insure against a deeper downturn because we believe that inflation pressures are stable at this point. So therefore, we can afford to be more aggressive and start more aggressively and buy that insurance policy.
Jim, what does all of this mean for the markets? I mean, today it means risk on almost everything, right? Do you think that that is sustained, not just through the coming days, but as we continue through this cycle?
Well, if we look at the data, right, so we have the Atlanta Fed GDP now forecast somewhere around 3%. We have the employment situation. We had jobless claims today. It was relatively, a good number, a strong number for the labor market. The labor markets have been, printing a little bit better and showing some signs of at least stability. So you have a Fed that with a 3% growth rate in the third quarter, the jobs market still today, at least for right now, in relatively good shape. We had decent retail sales. We had slightly higher in PPI and CPI, and they elect to cut 50 basis points. So what they're basically saying is that going into the future, if we look at equity markets, that they're saying that future earnings, if we go into 2025, that those earnings are likely to be more valuable to investors, meaning that when they think about 2025 full year earnings, the consensus is around $280. What multiple would an investor pay on that $280 consensus view? And the answer is coming back that somewhere around 20 or 21, which when you put those two things together suggests an S&P 500 of closer to 5,800, even 5,900. So, or even possibly slightly higher than that. I'm not saying that that's the forecast, that's my view. All I'm saying is that upside tail risk, I'm going to call it an upside tail risk, becomes much, much more likely than what we saw before prior to the Fed cutting 50 basis points.
Well, we'll see even if that's not a forecast, we'll see directionally if that's where we're headed. Jim, it's great to see you. Thanks a lot for joining us.
My pleasure. Thank you.
Let's get to some breaking earnings news from FedEx. Those shares are sinking almost 10% after the shipping giant reported numbers that missed estimates by a pretty wide margin here. $3.60, is what the company's reporting in its fiscal first quarter. $4.77 is what analysts have been anticipating. As you see, revenue of $21.6 billion, also short. The company looks like it is cutting the upper end of its full year earnings forecast, now looking for $20 to $21 a share in earnings for the full year. It had seen $20 to $22 a share. The other thing that really jumps out here is the operating margin for that fiscal first quarter, 5.6% versus the 7.4% that is that have been forecast. The company is adding to its buyback authorization of to the tune of $1.5 billion, but that doesn't seem to be doing anything to forestall the declines. The company is saying demand trends were weaker than expected. So all of this contributing to that decline that we're seeing in the shares.
Yeah, I remember the stock heading into this print, it had a nice run, Julie. It was up about 20% this year heading into the report. FedEx, of course, you watch closely, seen as a bellwether, and certainly you're going to want more color and commentary about customer demand trends, especially as you're now heading into the holidays. Commentary about price sensitivity will be key. Big issue will be impact and progress on its cost initiatives as too, but initially here, after hours, clearly a lot of disappointment.
Yeah, and looking at the statement here, Raj Subramaniam, the president and CEO of the company, referring to this as a challenging quarter, but at the same time talking about focusing on reducing structural costs, growing revenue profitably, and leveraging their data to build their network. So not getting a lot more insight yet. We'll have to wait for the call. There was some talk about the Federal Express overall, I should say, the operating results. There was one fewer operating day, but that doesn't seem to be, that wouldn't have that big of an effect. Lower U.S. domestic priority package volume was something also that the company was saying was weaker here. Freight also lower, a decline in weight per shipment, reduced priority shipments, and also one fewer operating day. So those are some of the things that appeared to be weighing on things.
Yep, all attention now on the call. All right, coming up, as Las Vegas hit its peak, I'm speaking with the CEO of MGM Resorts International to check in on the state of Sin City. Stick around, much more market domination overtime coming right up.
Welcome back to Market Domination Overtime, sponsored by Tasty Trade. As the AI revolution continues to grow, so does the issue of energy consumption. With pressure mounting on electrical grids, companies are trying to find more efficient ways to supply that energy demand from those data centers. We've got the CEO of one of those companies joining us now. That is Peter Herweck of Schneider Electric. Thank you so much for being here.
Thank you for having me.
So, Peter, we talk a lot here about AI demand and the demand it is then putting on the grid. You guys sit in sort of that attempt to help things be more efficient, help that energy flow through your electrical components. Where are you seeing the most acute need right now? And is there really a mismatch between the energy demand and whether it's being met?
So, you know, of course, it depends geography by geography. But if you look at the data centers worldwide today, they use roughly 1.3 to 2% of the global energy, and we anticipate this to double until 2030. So there is quite a need. That would be then the size of power consumption that you have in Japan for all the data centers worldwide. So it is big, but it is companies like ourselves. You know, we furnish the electrical and the cooling management in data centers. In fact, we're probably the largest in the world in this regard, and go from grid to chip and chip to cool. It requires to find sustainable ways of doing it, and of course we have some solutions to do that.
So what is the best way in order to do that? And I guess I would ask also, is it a matter of increasing energy output, or is it a matter of increasing energy efficiency? How important are each of those components?
So, 23 was one of the first years where we really see energy consumption go up in a long period of time. And since data centers play a big role on the electrical consumption, there's also energy forms that are non-electric. It has been top of mind today. So the key is really to figure out how can we do this with more renewables, how can we do it in a more efficient way, and we have a lot of clients that also buy sustainability consulting from us. A good client that we have in this public digital reality, they bought, for example, 5 large power purchasing agreements for renewable energy. So the data centers they're building at the moment are all with renewable energy. And so the money that goes into those purchase power agreement, PPAs, is then used to build out more renewables, which is, I think, the way we want to go.
Are you seeing any kind of flagging in demand at all for these kinds of products, or is it only accelerating?
So, I'm in New York speaking with some of our owners, and they ask me exactly the same question. As somebody who furnishes the electrical train and the cooling train into the data centers, we're industrial people, so it requires electricians, plumbers, construction companies, and so forth. And in this world, you don't have exponential growth because it requires the people to do it. Now, when you talk about software and when you talk about some of the GPUs or the processors that go into the data center, that's a different world where people do reservations for a couple of years into the future. We see very solid growth, and we don't see a change in demand at the moment. Probably we have visibility until 28.
And you talked about the different geographies. I know you have a big business in North America now, and that has been growing. I think it's the biggest part of your business now. I've seen some estimates that we are going to see even more rapid demand, potentially, or nearing the same rapid demand in the Asia-Pacific region over the next 5 years, say. Is that what you're seeing as well, and are we going to see the balance shift at all?
Yeah, so many people know Schneider, and I think we're a French company. We're listed in the French Stock Exchange, but our largest geography is the US, followed by China, followed by India, and then number 4 is France. In fact, 5 to 6% of our revenue are in France, so it's small. The data center expansion, in particular when we're talking generative AI, you have more power requirement, and a lot of the companies want to do this in a sustainable way with little CO2. So they go to geographies where there is a lot of power, a lot of land available, because you need to have the land and the power usage. So we would see data centers being built in geographies that we haven't seen before to learn those models, be it in Australia, be it in Japan, be it in Singapore, in the Middle East, in countries in Europe that you wouldn't think about, the northern Nordics, because they have a lot of renewables and they have a lot of land, or in Spain, where you have a lot of wind, a lot of solar energy, and also in Southern America, where you have a lot of hydropower that is available, and also renewables, and that's what companies are worrying about. So the data center movement is really a global movement.
One other thing I wanted to ask you about is you all are rolling out new EV charging for commercial use. Can you and that's brand new if I'm not mistaken. So just talk to us a little bit about that new product.
Yeah, so one needs to also understand a little bit the demand environment in this regard. And if you move to California, for example, want to build a new house, then the requirement is you put solar on your rooftop, and then all of a sudden you become an energy generator, right? And then you say, what do you do with the energy? Am I feeding it back into the grid, or am I using it for my own vehicles? And then people start putting a battery also into their houses, have 2 electric vehicles. So the management of the energy in the building becomes much more decisive. So we've in the U.S., in California, we've launched new chargers for the home. So it's a Schneider Charge or a Schneider Boost, which is a battery or a converter. For us, the potential has increased by the factor of 10 for these houses, because it requires a lot of energy management. You have producers, you have storage, you have grid connection, and everything needs to be managed with the software. So it's big for us.
Thanks so much for coming in. It was really nice to meet you and to chat about the business. I appreciate it.
Thanks very much, Julie. Great to be with you.
Got to get to some breaking news now. Breaking news that Nike CEO John Donahoe is out. He will be replaced by Elliott Hill. Hill also will become a director of the Nike board of directors and a member of the executive committee. Now, Elliott Hill had been with Nike previously, I believe, so he is what we like to refer to informally as a boomerang here. Donahoe had been having some issues at Nike in recent years. There had been some sort of back and forth about Nike's relationship with the wholesale channels versus its direct-to-consumer business. As of late, there had been more concerns over Nike's pace of innovation and that its sort of very dominant role in the sneaker space had been flagging to some degree. So that is sort of the backdrop here for this now management change that we are hearing about today, with the stock down 25% year to date. That's what's going on.
Yeah, I mean, we've talked to any number of analysts on the show, Julie, who've talked about this name. It is deep in the red this year. It's in the red over the last 12 months. I'm just looking. So, and we've heard comments about, critiques of management, critiques of innovation, but clearly a big shakeup here in the C-suite.
And to talk more about this, it just so happens that our executive editor, Brian Sozzi, is still in the office. He has covered Nike pretty extensively.
Yeah. Okay, well, here we go.
Did we just grab you on here? Have you had a chance to look through
I
some
ran
stuff?
over here in my white Boss sneakers, which I think is very telling. And in the green room, I have a couple pair of On sneakers. On running.
Well, I'm sure you have Nikes as well.
But this speaks to, I really have gotten rid of a lot of them, because I think that speaks to part of the reason why John Donahoe will go down as probably the worst CEO in Nike's history. I mean, there hasn't been many of them. You had Phil Knight, Mark Parker driving the company for many, many years, and I don't think it's any small coincidence that Mark Parker is the main man listed at the top of this press release detailing Nike here. Bottom line is Donahoe ruined a lot of relationships with the like of Foot Locker and many other companies. He has overseen Nike during a time when On Running and a lot of upstarts in the trading space have gobbled up market share from the company. He's continued to dump a lot of old school Nike sneakers on the marketplace that nobody cares about anymore, or not caring about them to the extent that they used to. And what do you get? Over the past 5 years, according to Yahoo Finance data, stocks down 8%. Not surprised to see Nike shares up 8% here. Overall, the takeaway is this: Nike is going back to the well, to someone that has the deep relationships, the deep partnerships, respects the history of Nike. That's what you're getting here in the new incoming CEO of Nike, and I think that's why they did this. And we saw this essentially all the writing on the wall. The stock is under pressure. You have Phil Knight and his son on the board. They're losing massive wealth. What has happened to Nike is absolutely embarrassing. It has been time for change. You've seen a lot of media folks, a lot of our competitors really get on John Donahoe in the past month. I think the FT just dropped a story a week and a half ago. I'm not surprised at all.
What are the new levers, though, that the new CEO then, Sozzi, has to pull here?
Make better stuff. And I think if you talk to a lot of
so it's innovation.
It's innovation. Yeah. Bring back quality to what Nike is making. I think they've over-diversified their supply chain, and the quality of the products are just not where they used to be. But where they don't have an answer for is the rise in some of these upstart brands. We followed On Running, the co-founders there. Hoka. You followed Hoka and have been on the Hoka story from day one over at Deckers. Massive market share in running. On massive market share in running. It's unclear how Nike gets that customer back. For whatever reason, consumers have gravitated to sneakers that maybe they're more comfortable.
Well,
maybe they look better.
And guess what? It's not just Hoka and On. If you walk around New York City Every 20-something woman in this city is wearing Sambas.
Yes.
Adidas shoes.
Yes.
They are not wearing, I mean, maybe some of them are wearing the Hokas and the Ons, but you see so many, yeah, you still see a lot of Air Force Ones. Okay, fine. But increasingly that is, so it also has to do with fashion, of course. But it also, Nike sort of flooded the zone. A lot of different SKUs that it had rolled out.
Well, I'll say
please.
too. When Don Ho was appointed, of course he was the long time on the board of PayPal too, longtime executive, former eBay CEO. But it was always strange to see a tech-focused executive leading a company that thrives and whose top and bottom lines are driven by product and excitement. It's not driven by the Nike app. Who gives a damn? Get them the best sneakers to market, upsell customers to higher priced offerings, and improve your margins. That's always been the story of Nike.
By the way, Elliott Hill had retired from Nike as president of consumer and marketplace.
And that also shows you
a
succession problem too, that you're dipping back into someone who's been retired at the company for about a year. I think you could realistically, he'll come in here, reset the company, get the foundation right, and maybe under 2 years hand off to the next generation of leadership at Nike.
By a complete stroke of luck, whenever we have just enormous retail news, Sazi is in the newsroom.
It's been a strange week. I also remember when Under Armour CEO got pushed out too. I don't know. I'm just like working on zero sleep after.
You're the guy to go to.
So I got to get out of here.
Sazi, thank you. Perfect timing. Earlier today, I caught up with the CEO of MGM Resorts International. Take a listen. The Skift Global Forum is wrapping up in New York City. It is known as the travel industry's premier annual event. And joining us from that event now, Bill Hornbuckle, MGM Resorts International President and CEO. Bill, it is good to see you.
Great to see you. Thank you.
Bill, I was talking to some analysts today. I want to dig right in to Vegas and the trends you're seeing there. Speaking to these analysts, and they said, Bill has done very well in Vegas, no doubt. But the question investors have is, they said, how does he keep this momentum going? How does he kind of build off the elevated base from here? How do you answer that question, Bill?
Look, I think that's been a question. I just saw a cover of Life magazine back in the 60s, and it asked the exact same question. Has Las Vegas hit its peak? Will ebb and flow. 2023 was an amazing year. We obviously started this year with the Super Bowl, Formula One, all within like 90 days of each other. But at our core, convention business remains strong. International business after the pandemic has returned, less China. China is still a challenge for us all, and it's an important sector for us. And so the event activity case itself has never been stronger. This weekend alone, massive UFC fight at the Sphere. We hosted Canelo with T-Mobile. And so our ability as a destination to run in the low 90s has never ceased. Even during the 2008 Great Recession, it went down to 82%. So driving traffic, driving people is kind of what we do, and we do it well, we think. Ultimately, it's about return, but Vegas has ebbed and flowed and will continue to ebb and flow. And long haul, there's nothing like it anywhere in the world. The experiences we provide are like nothing else at scale that anyone can provide. And so I'm pretty confident going into the future.
Your portfolio there in Vegas, Bill, it does cater to all kinds of consumers. I'm curious how healthy, how resilient the consumer looks to you. Or does it depend and differ, Bill, where you sit on that socioeconomic ladder?
Look, it's universal. When the tide goes up, most participate. I will tell you, last couple of years, it has been about the luxury sector. Our ability to drive event activity, drive weekends, to drive average rates on the weekends has been very strong. Although other side of the spectrum, we have 8 regional casinos all performing on par and as best as they've ever performed. And so obviously that tends to attract a different clientele base. And so we see it's pretty universal. But generally, particularly on the high end, those who've enjoyed those kinds of experiences continue to come. We're looking forward to Formula One again coming up and some of the other activity we have.
You mentioned the Sphere, Bill, and incredible what UFC's Dana White pulled off there. I am interested, those non-gaming events, Bill, how are they impacting MGM?
They do a lot. Look, I think over half of visitation is driven by event activity. People have always wanted and needed an excuse to come to Las Vegas, and we continue to provide it. So whether it's fight weekend like we just had, or now with Allegiant Stadium, a football game. Last year Allegiant was programmed for 43 events, everything from Taylor Swift to the Super Bowl. And so continuing that activity case will continue to drive Obviously, we've now ventured into sports in a meaningful way. We have baseballs coming down the road here in 27, 28. We're after and want and hopefully seek an NBA team. And so how that has flushed itself out has been very meaningful for visitation and particularly around the higher premium end customer.
Bill, I want to switch gears, talk about what you're seeing internationally. You mentioned China, economy there is weak. How are you navigating that?
Look, pretty straightforward. I mean, we've now reached a plateau, I think, in Macau. I think that marketplace is going to come to about 25 or 26 billion. It was at 35 pre-pandemic. Our particular company has plateaued in terms of share. We now enjoy mid-teens in terms of market share, so we're equally as excited by that. And remember something, to fill Macau, to keep it active, it's literally less than a 1% penetration rate into the population of China. And while it matters, and it does, what we need, who we focus on, and the type of customer that comes today continues to be strong, and we're excited by what we think will happen in 25 and beyond.
And Bill, let's talk sports betting as well. You got a big online betting company there. You've been investing in that product. NFL is underway. Bill, I'm curious, what are the trends you're seeing play out in the business?
Well, for us, it's always an adage. If I don't know what team to root for, I always root for the dog because the dog provides generally a win in sports betting. This weekend was a good example of that. So the first couple of weeks have been great for the business, but for us particularly, it's been transformational. You know, we've done a transformation on our product offering. We now have single account, single wallet. That simply means someone can come to Las Vegas, put money on an account, and if they win, take it home and continue that activity case in a place like Colorado. So for us, that notion of omni-channel is a big deal. Our iGaming products we think are unique and special. We have one of the largest jackpots in the world online. We bought a content company called Push that enables us to put out our own branded MGM products, which are really resonating in certain markets. And we've just begun live dealer gaming out of Bellagio and MGM into the UK and some of our other Leo Vegas markets, which is extremely exciting. I think has a really long-term tail on it. And you touched on this, but I want to double tap on it. Bill, when you think about BetMGM, how is it different than the competition, FanDuel, DraftKings? Well, I think the key differentiator is ultimately, as a loyal customer and a connected customer, what it can mean for enjoying experiences, which I think our opportunity to bring things to life, to then bring you to Las Vegas, to bring, we had customers at the Super Bowl last year, to bring you to something like Formula One, to take the activity case and make it real, we think is compelling and meaningful, and we don't know, we've seen people do it. We're excited by it, particularly the VIP segment of that business is motivated by that kind of activity. Bill, appreciate your time. Thanks for joining us today. Thanks. Have a great day. Stick around. Asking for a trend coming up next.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. What a difference a day makes. Stocks soaring the day after the Federal Reserve cut rates by 50 basis points. The Dow and S&P 500 both closing at fresh record highs, but it was tech stocks that were the true leader on Wall Street, and we're taking a deeper dive into the tech trade as some of the biggest names in the sector hit new highs. Plus, using artificial intelligence to invest, we've got the CEO of a new venture that's using the emerging technology to help make decisions for your portfolio. And the future of TikTok, I'm speaking with billionaire investor Frank McCourt about his bid to buy the social media giant and how he wants to transform the app. The AI boom has made traders eager to get in on the artificial intelligence trade, but a new firm is going straight to the source on AI investing. Intelligent Alpha, using artificial intelligence as its investment committee designed to construct various investing strategies. And here with more on how AI can power your portfolio, we have Intelligent Alpha founder and CEO, Doug Clinton. Doug, great to see you on set.
Likewise.
So let's start at a high level, Doug. So what you're using AI for is to construct these different investment strategies. It's AI as portfolio manager, right? Walk us through it.
That's exactly right. And first of all, I'm having flashbacks because 7 years ago, we launched my other company, Deepwater, with you. I remember being in San Francisco when we announced that. So it's fun to be here with you to talk about Intelligent Alpha. Here's how it works. We have created an investment committee built on AI, 3 different large language AI models, so GPT, Claude, and Gemini, which people are probably familiar with. They analyze data and a philosophy that we give those committee members, and then they create a portfolio of stocks that reflect whatever portfolio or exposure we want the AI to create for us.
And you also have an ETF, Doug, right, that's leveraging this strategy?
We do. We just launched the ETF yesterday on the Nasdaq. So it's called the Intelligent Livermore ETF. The ticker is LIVR. And it basically analyzes some of the world's greatest investors and traders. It sort of figures out how do they think about the world today. And then it constructs a portfolio that reflects those views.
And so in that ETF, I would find names such as what?
Right now, there's a few different big themes, and I'll give you a few names. So the themes that AI is interested in right now, because it thinks the world's greatest investors are AI. It likes the Asian trade. It likes Latin America for geo exposure. And then it also has some defensive exposure, so healthcare and consumer staples. You will find names that are familiar, like Meta. That's one of its top holdings. There are also what I think are more contrarian names, like Pinduoduo, Chinese stock. It was down 30%.
That is interesting,
Yeah, a month ago, and there's kind of an alternative bet there. They think that stock might bounce back.
I get the potential, and help me if I'm thinking about this correctly. I understand the potential that you've got to minimize the human involvement. And there are upsides to that. I mean, you could argue, okay, I'm minimizing emotion, right? But is there potential risk there too? Are you minimizing all the good that can come with that? Just the creativity, the dynamism, the ingenuity of the human mind?
I actually think in a way, in terms of our process, it actually augments creativity in a sense, because where I think humans go wrong as investors is that they succumb to emotion eventually. Given enough time, we'll make a dumb decision because our portfolio is up a bunch and we think we're geniuses, or it's down a bunch and we think we're terrible, and it's just the way it is. But what I think AI does, with the guidance of a human analyst, which is me in this case, kind of saying, here's the exposures we're looking for, now you go and figure it out, being the AI. I think it optimizes the human creative element, where we kind of figure out what exposure do we want, and then the AI has free reign from there.
And you mentioned how humans, they'll make mistakes, right? AI, though, I mean, you can get mistakes there too, right? Inaccuracies, hallucinations. How do you try to minimize that?
So we have essentially a redundancy layer before the portfolio is approved and actually applied in any portfolio that we do. A human analyst will review the portfolio, make sure there's no hallucinations that just don't make any sense. But there's a funny thing about hallucinations. You just mentioned creativity a minute ago, Josh. Another word for hallucination is creativity, right? Mark Andreessen has talked about this. Like they're kind of closely aligned. And what's funny is sometimes hallucinations that we see these AI committee members make, they're actually really interesting stock ideas. And so I've been telling people this just sort of like anecdotally, just seeing, oh, that's a weird one that the AI put in. It wasn't in the set that we gave it to analyze. but it actually makes sense for the strategy. Some of those, for some reason, it's like those stocks tend to perform the best. I don't know what it is, but sometimes hallucinations are a good thing.
Doug, great to have you on set. Thanks for joining us.
Be here.
Stick around. We're asking for a trend right on the other side. Earlier this week, TikTok made its case in court against a bill that would require it to be divested by its Chinese parent company ByteDance, or else risk a nationwide ban. And joining us now is someone hoping to acquire that company, Frank McCourt, Project Liberty founder. Frank, it's good to see you. Maybe I want to start at a high-level question, Frank. I'm curious whether you agree, you think that TikTok does represent a national security risk, Frank.
Yeah, absolutely. We absolutely believe that. We agree with the government's position. I think it's pretty clear to everyone now that the Chinese Communist Party controls TikTok, and that they're holding the information on 170 million Americans is not a good thing. It's a real threat, and of course, the ability to manipulate 170 million Americans is even more of a threat.
And Frank, there is some skepticism, though, as this kind of plays out, that the CCP, the Chinese Communist Party, would actually ever permit a divestment. How do you think about that?
Yeah, well, look, I don't have all the answers, Josh, but we're making a bet here, right? We believe, number one, the government's position will be upheld, and we're going to find that out shortly. As you say, the oral arguments were just this past Monday, and so once we get through that hoop, we'll see where we stand. And I think that my personal view is that ByteDance is going to have an important decision to make, which is whether they shut it down or sell the U.S. portion. And I'm betting they sell it. And I don't want them to shut it down, nor do the 170 million users want it to be shut down, because people are using the app. They enjoy the app. That's not the issue. The issue is how the people's data is being used. And what our plan is to actually migrate the 170 million users over to a new protocol where each individual would control their identity and their data.
So that's interesting, Frank, because that's a big question, right? I mean, let's say they divest and the sale happens. A question that's out there, and it's a fair one, is it'd be hard to imagine they part with the algorithm, the secret sauce. So what would American investors like yourself, what would you actually really be buying at that point?
Yeah, you'd be buying obviously the brand, the 170 million user base, and all the content. And yeah, I want to highlight that we're not interested in the algorithm. We don't need it, and we don't want it. And China said they're not going to let go of it in any event. So, as a matter of fact, I think we may be the only ones that check all three boxes. And what I mean by that is that we check the CFIUS box. We're not a national security threat. We're American, not foreign. We check the antitrust box, right? We're not big tech, so we don't have an antitrust issue. And we have built the tech stack that would enable us to onboard the user base of TikTok and do so in a way that actually, as I said earlier, gives people control of their identity and their data and so forth. So we check the three boxes. I think that's very, very important. We don't want to need the algorithm, as you point out. And so, yeah, I'm pretty excited about our prospects. Of course, we'll see. We don't have a crystal ball in terms of what the outcome of the litigation is, and we certainly don't know what TikTok or ByteDance will ultimately decide to do.
What about, Frank, just the politics of all this? And by that I mean, Trump and Harris are both on TikTok. Does their enthusiasm in any way, cloud whether this thing does get divested and sold?
Yeah, I think you're touching on a very, very important point, and herein lies the conundrum, right? We have technology. TikTok is an example, but our own big tech platforms do the same thing. They scrape our data, aggregate it, apply algorithms, and get us to do stuff. And we're learning that some of that stuff is not good, right? It's harmful to democracy. It's harmful to our information ecosystem, the mis and disinformation. It's hard now to know what's fake and what's real. And of course, we're reading more and more about the harms to children. So we need to fix this internet technology, and we can. I mean, that's the good news. Project Liberty is all about a solution here. We're not here to just throw another log on the fire and say the world's coming to an end. The internet is something that's here to stay. We all use it. Presidential candidates use it. The point is, the platforms are operating in a way that's very exploitive, and we need alternatives to TikTok, alternatives to the current big tech platforms, where we get the good out of these platforms without having to suffering the harms and suffering the bad.
Frank, thank you so much for joining the show today. Big, important topic. Appreciate it.
Yeah, Josh, thanks for your time. You take care of yourself. Bye-bye.
Coming up, Nike CEO is stepping down. We're going to speak to an analyst about the move when we return. Nike CEO John Donahoe is stepping down, replaced by Elliott Hill. Nike veteran Elliott Hill will become president and CEO effective October 14th. Here with more is Bernstein senior analyst Anisha Sherman. Anisha, it is good to see you. So big news after hours. Elliott Hill is in, John Donahoe is out. Investors, at least initially here, celebrating this. Stock's up about 10%, but you know the company backwards and forwards. Anisha, what do you make of this news?
I think this is very good news for the stock, both the executive named as well as the timing. Elliott Hill has worked at Nike for 32 years. He's a product guy. He's ran retail in EMEA, in US, in North America. He knows the company and the product very well. And from what we've heard at Nike, amongst former employees that we've spoken with, he's also very well liked at Nike. So this is not only the right skill set in terms of understanding product and understanding Nike, I think he will be the right leader in terms of communication and vision, because he's already very well known and liked within the organization. And the timing is great too, because Nike's having an investor day in exactly 2 months on November 19th. And they've promised talking about medium-term targets. It doesn't make a whole lot of sense for an outgoing CEO to talk about medium-term targets. So you need the new leader in place before you can have that conversation. So the timing works very well also.
Anisha, you sound very positive. It's Julie here. It's good to see you. You sound very positive on Nike. But the stock is down 25% year to date. And I understand you wanting to look forward and the idea of this new CEO, but I do want to spend at least a beat talking about John Donahoe. How much damage did he do at Nike?
So a lot of the blame has been placed on Donahoe himself and his lack of a product background. And I think that did contribute. It helps to have a CEO with a brand and product background who can make calls that need to be made, who can identify where there are red flags, because they have the experience to do that. And the outgoing CEO did not. But part of the problem also was not his specific experience, but the fact that the company focus moved away from product and moved towards tech and digital and other things. And so they lost talent in product, and they didn't spot some of the red flags in product. They cut out a lot of the feedback loops in product. So it was an organizational shift, not necessarily the background of one individual, but the organization's culture shifted away from product. And that's something that needs to be fixed.
So Anisha, Elliott Hill now coming in, what are his priorities, Anisha?
So I think the first priority will be to set a path forward. And so the investor day is coming at a good time. He needs to set the path forward for the next 5 years, set some targets, give investors a sense of where this company is headed and what kind of numbers to expect, what kind of algo to expect for growth and earnings growth. And that will set the course of investor expectations and probably stabilize the stock a little bit. And then he needs to do more work. I mean, this is not a slow, this is a tanker that needs to be moved, and it takes time. But I think investors will give him a pass if the targets sound reasonable, the goals sound reasonable, and will give him a pass for the next 6 months to a year to fix the ship before it starts working again.
Anisha, what needs to be the goal in terms of product?
So Nike has somewhat lost its mojo in the market. It made several different mistakes. One was just the product process got so convoluted and delayed with a couple of different reorganizations, changing the way product reviews are done, to the point where even small incremental additions take a year to get out to market. So we need some more nimbleness. We need some more speed and reaction to the market. And then the second piece is they just need to control scarcity in the market. They over distributed several of the hot products to the point where they lost their brand heat. So they need to regain that scarcity and demand pull.
Anisha, as Nike made these missteps, lost its mojo, as you say, who gained from those missteps?
What happened at the same time is there were a couple of emerging brands, On and Hoka in particular, that took over the shelf space that Nike gave up, that gained a lot of the consumers that didn't like what they saw from Nike anymore. So they gained a lot of the market share. And then more recently, Adidas, which has been on a similar journey of its own with a new CEO and a turnaround, has had a great year so far. So they've gained some on the lifestyle side, where their Samba and Gazelle shoes are sort of the it shoe of the summer this year, and Nike's Jordans and Dunks aren't anymore.
And I know that you've got an outperform rating on Nike. Your price target's 109. Is that, especially with this management change, is that your top pick here in footwear, or would you look at some of those competitors?
I think Nike is not an immediate pick. I mean, the CEO catalyst was on the horizon. We knew it was coming at some point before the investor day. We expected that it would be at the the October 1st quarterly results. We didn't expect it to be sooner than that, but that isn't a catalyst that the market was expecting. Is very good for the stock. The November investor day will be another catalyst. But beyond that, we just need to see this turnaround play out. So it's going to be a little bit of a slower burn beyond that. I think elsewhere in the market, you can probably find faster recovery stories for more beaten down names. But I do like Nike. I think I like it over the next 6 months, and I like it on a longer term horizon.
Anisha, big news after hours. Thank you so much for helping us think through it. Appreciate it. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.